Ever wonder what the future holds for interest rates? You're not alone. The world of economics, investments, and even personal finance is significantly impacted by the trajectory of interest rates. The key to understanding this lies in the Federal Reserve's minutes, a treasure trove of insights that sheds light on potential future rate hikes. But the question is, what does proceed carefully mean in the context of these rate hikes? So what do these Fed minutes tell us about the future of interest rates? Let's delve into it. To understand future interest rates, we first need to comprehend the role of the Federal Reserve. In essence, the Federal Reserve, often referred to as the Fed, is the central bank of the United States. It's the monetary policy superhero, with its primary mission being to keep the economy stable and healthy. Now let's talk about interest rates. These are essentially the cost of borrowing money, and they play a crucial role in our economy. When the Fed changes the interest rates, it directly influences the cost of borrowing, affecting everything from your mortgage payments to credit card bills. So how do the Fed and interest rates connect? Simply put, the Fed uses interest rates as a lever. By adjusting them, the Fed can control inflation and stimulate economic growth. When the economy is sluggish, the Fed might lower interest rates to encourage spending. Conversely, when the economy is overheating, they may raise rates to curb inflation. Now that we understand the Fed and interest rates, let's look at the recent Fed minutes. The Fed minutes are a treasure trove of information if you know how to decipher them. Now, let's jump into what these minutes actually are. They are a detailed record of the Federal Reserve's policy-setting meetings, which offer insights into the economic conditions that influence their decision-making. In essence, they're a bit like reading the central bank's diary. They shed light on the bank's thought process, and more importantly, they drop hints about future interest rate hikes. Now, let's consider the recent Fed minutes. A phrase that pops out is, proceed carefully. This suggests the bank is being cautious about increasing interest rates. But why? It's likely due to a mix of factors, such as inflation pressures, employment numbers, and global economic conditions. Deciphering the minutes is like piecing together a puzzle. It's about connecting the dots to see the bigger economic picture. So, what does proceed carefully mean for future rate hikes? The answer might surprise you. Proceed carefully sounds cautious, doesn't it? But what does it mean in the context of interest rates? Essentially, this phrase implies a deliberate, measured approach to future rate hikes. The Federal Reserve won't rush into decisions, rather it will closely monitor the economy's pulse, keeping a keen eye on various indicators. The goal is to strike a balance, ensuring economic growth and stability without triggering inflation. In other words, while rate hikes are on the horizon, the Fed plans to navigate these waters with care.